While most of the world is distracted by stock market swings, crypto volatility, elections, and headlines designed to keep you emotionally exhausted, something very quiet and very calculated is happening in the background. A $300 million bet has just been placed against one of the most critical metals on Earth. Not against a meme stock. Not against a failing company. Against silver. At the exact same time, 54 nations gathered in Washington behind closed doors to discuss what they officially call critical minerals. But what they are really talking about is power. Industrial power. Military power. Economic power. And if you've been around markets long enough to recognize when something doesn't quite add up, then you already feel it. There's tension in the system. Before we go deeper, I'll ask you something small. If you value this kind of research and perspective, hit subscribe. These videos take serious time and effort to put together, and we're building an audience that wants intelligence, not noise. That's it. Now let's get into it. On the Shanghai Futures Exchange, a single trader opened the largest short position in its history. Around 30,000 silver futures contracts. Roughly 450 metric tons of silver. A position worth about $300 million. The man behind it is a low-profile Chinese billionaire known in commodity circles for his precision and timing. He previously made close to $3 billion riding bullish gold trades. This is not an amateur gambler. This is someone who understands precious metals markets at a macro level. And now he is betting that silver prices will fall. The timing is what makes this extraordinary. Silver had already fallen around 16% from recent highs when the position was established. That means the trader was already in profit shortly after entering. But instead of placing this bet on COMEX in New York, he placed it in Shanghai. That matters because the Shanghai Futures Exchange operates differently. Different rules. Different liquidity structure. Different participants. And most importantly, a different price environment. At that time, Western silver spot prices were trading around $70 per ounce. In Shanghai, spot silver was closer to $81, and futures contracts were trading near $99. That is a massive premium. An $11 or more difference between East and West. In commodity markets, such price gaps are not random. They signal physical demand pressure. They signal that buyers in China are willing to pay significantly more to secure actual metal. So here is the contradiction. On one side, extreme physical demand driving local premiums. On the other side, a massive short bet expecting prices to fall. When markets show contradictions like this, it usually means there are deeper strategic forces at play. To understand the stakes, we need to step back and look at the silver market structurally. According to data from the Silver Institute, global silver demand in recent years has exceeded global mine supply. In 2022 and 2023, the market recorded structural deficits where industrial demand plus investment demand outpaced annual mining production. That means more silver is being consumed than is being extracted from the ground each year. Not occasionally. Consistently. Industrial demand alone accounts for more than 50% of total silver consumption. Solar panels are a major driver. Each photovoltaic panel uses roughly 15 to 20 grams of silver. Global solar installations have exploded, particularly in China, Europe, and the United States. China alone has been installing record-breaking solar capacity year after year. Hundreds of gigawatts of new capacity require thousands of tons of silver. Then there is electronics. Every smartphone, every computer motherboard, every television, every electric vehicle relies on silver for its unmatched conductivity. Silver is the most conductive metal on Earth. Copper is cheaper, yes, but it cannot fully replace silver in high-performance applications without sacrificing efficiency and reliability. In critical systems, especially defense electronics, substitution has limits. Defense demand is rarely discussed publicly in detail, but modern military systems are deeply dependent on advanced electronics. Radar systems, missile guidance, communications infrastructure, satellite components, and electronic warfare systems all rely on silver-based contacts and conductive materials. As global tensions rise and defense budgets increase, that demand layer grows quietly in the background. Medical applications add another layer. Silver's antimicrobial properties make it valuable in wound dressings, surgical tools, hospital coatings, and water purification systems. As healthcare infrastructure expands globally, this demand segment increases steadily. Now look at supply. Around 70% of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. That means silver supply is not directly controlled by silver prices. If copper production slows because copper prices fall, silver output declines even if silver demand is rising. This makes the supply curve relatively inelastic. You cannot simply flip a switch and produce more silver because it is not the primary revenue driver for most mines. Primary silver mines face their own challenges. The easy deposits have largely been discovered. New projects take 7 to 15 years to permit, finance, and construct in many developed countries. Environmental regulations, community resistance, rising labor costs, and higher energy prices all increase production costs. Some estimates suggest that many new primary projects require silver prices above $90 per ounce to be economically viable. Yet if the global benchmark is around $70, those projects remain undeveloped. Now add geography to the equation. Mexico, Peru, China, Poland, and Chile account for the majority of global silver production. Political instability, regulatory shifts, or trade restrictions in any of these regions can significantly disrupt supply. That concentration creates geopolitical leverage. Meanwhile, there is the paper market. Futures contracts, options, derivatives, unallocated accounts. On exchanges like COMEX and Shanghai, far more silver is traded on paper than exists in physical warehouse inventories. This is normal in commodity markets. Most contracts are cash settled. Very few participants ever request physical delivery. But that structure works only as long as trust remains intact. As long as paper claims are accepted as equivalent to physical metal. The Chinese strategy, if viewed strategically, appears sophisticated. Massive short positions in futures markets can exert downward pressure on global price benchmarks. At the same time, physical silver imports into China through channels like Hong Kong have been substantial over the past decade. Physical metal flows in. Paper positions help shape price expectations. If prices remain suppressed relative to physical demand, accumulation becomes cheaper. But then something else happened. In Washington, representatives from 54 nations, representing roughly 2/3 of global GDP, gathered to discuss critical minerals. U.S. leaders emphasized that certain materials are foundational to technological and industrial capacity. They spoke about supply chain resilience, about dependence on adversarial nations, about price instability preventing domestic mining investment. When policymakers use phrases like critical minerals, they are not speaking casually. They are signaling that access to these materials is now considered a national security issue. Silver is often not as publicly highlighted as lithium or rare earth elements, but it is equally embedded in modern infrastructure. The message from Washington was clear. International commodity markets, particularly for strategic resources, may not be functioning in a way that supports long-term industrial independence. Erratic and suppressed pricing can discourage domestic production. If prices do not reflect scarcity, capital will not flow into new mines. If capital does not flow, supply deficits widen. If deficits widen, dependency on dominant suppliers increases. So what happens if the United States and its allies decide to actively support higher prices for strategic minerals? Higher prices make Western mining projects viable. They justify domestic refining capacity. They incentivize exploration. They reduce dependency on imports. They also increase input costs for nations whose manufacturing models rely on cheap raw materials. China's export-driven industrial dominance depends heavily on competitive manufacturing costs. Silver is embedded in solar panel production, electric vehicle manufacturing, electronics assembly, and telecommunications infrastructure. If silver prices were to double or triple, input costs would rise significantly. Margins would compress unless those costs are passed to global consumers. This sets up a potential collision. On one side, a large short position betting that prices will stay suppressed or fall. On the other side, a geopolitical coalition signaling that suppressed prices undermine strategic interests and may need to be addressed. History shows that when paper markets diverge too far from physical fundamentals, adjustments can be violent. In 1980, during the Hunt brothers episode, silver prices surged from around $11 to nearly $50 in a short period before collapsing. In 2022, the nickel market experienced extreme volatility, forcing the London Metal Exchange to suspend trading after prices doubled rapidly due to a short squeeze. A short squeeze occurs when traders who have bet on falling prices are forced to buy to cover their positions as prices rise, accelerating the upward move. In a market with structural deficits and tight physical supply, such squeezes can be dramatic. If industrial users begin demanding guaranteed physical delivery rather than rolling contracts, warehouse inventories can be stressed. If strategic stockpiling increases simultaneously, liquidity shrinks further. In that environment, price discovery shifts from financial engineering to physical availability. Some analysts speculate that in a true scarcity environment, silver prices could exceed $150 or even $200 per ounce. Whether those levels are realistic depends on how severe the deficit becomes and how aggressively governments intervene. But the key point is this: commodities tied to industrial civilization cannot remain mispriced indefinitely relative to supply and demand realities. For manufacturers, the risk is operational. Secure long-term supply contracts now, or face unpredictable cost spikes later. For mining companies, higher prices could transform marginal projects into profitable ones. For investors, physical ownership versus paper exposure becomes a strategic distinction. Paper claims depend on counterparties. Physical metal does not. For governments, the stakes are larger than profit. They are about sovereignty. A nation without secure access to foundational materials is strategically vulnerable. Energy transition plans, defense systems, digital infrastructure, and manufacturing capacity all depend on reliable input flows. The billionaire who placed the $300 million short position is betting that the current structure holds. That paper markets continue to anchor prices. That geopolitical coordination fails to meaningfully disrupt the status quo. That deficits remain manageable. It is a calculated bet, not an emotional one. But mathematics does not negotiate. If annual demand consistently exceeds annual supply, inventories decline. If inventories decline long enough, something has to adjust. Either demand collapses through recession, substitution breakthroughs occur, or prices rise to ration usage and incentivize new supply.